I remember when I made my debut in the stock market, to me, knowledge of the stock market meant only one thing. That is, knowing the names of as many stocks as possible which were in the news. Then after going through some basic education, I realized that's not knowledge. That's called noise. Most of that noise came from the social media in general and the finfluencers in particular. To become a successful investor, we need to ignore the noise and focus only on a few stocks because it's almost impossible to study hundreds of stocks. If you feel you are also in a similar situation, please keep watching this video till the end. Because in this video, we are going to discuss how to very easily analyze a stock as a beginner and how to not lose money in stock markets. Namaste and welcome to Retail Investing. The most common mistake made by new investors happens even before they buy their first stock. And that mistake is not maintaining enough liquidity. If you don't keep any money in your savings account and put everything into stocks, you might soon find yourself in a situation in which you may have to sell future multi-bagger stocks at the wrong time and for the wrong price. This makes new investors incur huge losses. For equity investing, a time horizon of 5 years is the bare minimum. So before you buy your first stock, you need to note down a list of large expenditures expected in the next 5 years. And for those expenditures, sufficient money should be saved before buying any stock. I prefer keeping that money in liquid and debt mutual funds. Once you have done that, you are good to go into stock investing. Let's understand the first step of stock investing. Suppose you are playing football, but there is no goalpost in the ground. Then you are not really playing football. Similarly, if you buy a stock and you don't have any goal in your mind, then you are not really investing. So what kind of goals are we talking about? It could be as simple as buying your favorite smartphone. Suppose your favorite smartphone costs around 80,000 rupees, but you have only 20,000 rupees with you. So your investment goal should be 4x returns. But if you want to achieve that goal within 1 year, then you need to set realistic goals. Really great companies can grow at around 25% annually, and if you earn 25% CAGR, it would take you around 6 years to buy that smartphone. I personally would not buy that expensive smartphone because after understanding the power of compounding, I am really addicted to it. Let's start with a beginner stock analysis. Just before I had the courage to buy my first stock, I remember to me, stock analysis meant only one thing, and that is following the price of the stock. And the main reason for buying a stock was it's going really up. After all, newcomers in the stock market are introduced to cool phrases like Bhav Bhagwan Che. This phrase creates a sense of invincibility among newbies. After some self-education, I realized that value Bhagwan Che, not price or bhav. Success is almost guaranteed for any investor who can find the difference between price and value at the right time. The price of a stock does not reveal any information about the underlying business. Yet, it is the most tracked metric. Let's take an example of MRF and Reliance. The MRF stock is trading at around 98,000 rupees and the Reliance stock is trading at around 2,500. Does that mean MRF is bigger than Reliance? In reality, Reliance Industries is more than 40 times bigger than MRF. Buying a stock actually means buying a part ownership of the underlying business. If you don't trust me, you can try buying a share of Reliance Industries and you will see Mukesh Ambani himself writes to you every year in the annual report, "Dear investor, we have great future plans for your company." Back to beginner stock analysis. As a beginner, it's very easy to get overwhelmed by all those bombastic finance terms that everybody uses. Terms like enterprise value to EBITDA, net current asset value per share, EBITDA variance, and so on. I have never heard big successful investors like Mr. Monish Pabrai or Mr. Charlie Munger referring to those terms. Stock analysis must be kept so simple that even a 10-year-old child should be able to understand it. Every business is done with a profit motive. I think even a 10-year-old can understand that the difference between the selling price of a product and the costs associated with making the product is your profit. This profit is the business's earnings. Now we can look for how much of the company's products can be sold in the market to get an idea of how much earnings can be made from the sales volumes. As a beginner, if I were to analyze a stock within a few minutes, I would look for only one figure, and that is earnings. Earnings can justify the price of a stock. The easiest way to tell if a stock is overpriced is by comparing the price line with the earnings line. So how can a business increase its earnings? There are 5 basic ways by which a company can increase its earnings. It can reduce the costs of making its existing products. That will increase margins. It can raise prices of its existing products. If consumers cannot live without its products, the company gets pricing power. It can raise prices, which will improve margins. It can expand into new markets, which will increase sales volumes, which will also increase profit margins. It can sell more of its products in old markets. That can happen if the company has an edge over competitors and can grab market share from them. And lastly, the company can sell off a loss-making unit and invest the money somewhere else where it can make profits. A very successful investor and a great friend of retail investors, Mr. Peter Lynch, gave some wonderful precautions for newbie investors. I follow them religiously. Be suspicious of companies growing more than 50% a year. I remember implementing this on Adani stocks. In the year 2020, I remember everyone I knew was recommending Adani stocks to me, and the reason was obvious. It's really going up. So I decided to have a look at the annual reports. I did not find anything wrong with the companies. They are the typical capital-intensive infrastructure businesses which usually take a long time to give good returns to its investors. But those stocks were giving multi-bagger returns to investors in no time. How is that possible? Well, the FIIs made that possible. As a retail investor, I prefer staying away from those stocks in which FII play their games. I have noticed that almost all stocks which grow too fast have some kind of FII involvement in them. The EV industry is clearly a very hot industry today. I was thinking deep about investing into companies that supply lithium-ion batteries to EV companies. My favorite pick was Amara Raja Batteries. But following Mr. Peter Lynch's advice, I decided to stay away from the stock, and I am very happy with my decision irrespective of the recent movements of the stock price. Usually what happens with hot stocks in hot industries is that fierce competition destroys profit margins for almost all players. Recently, there is news that Tata is setting up a huge battery manufacturing plant, and Mr. Peter Lynch stands vindicated. It's totally okay to miss the first big move in a great stock. Sit back and watch if the company's plans are working. Most retail investors fall prey to FOMO, that is, fear of missing out. You might think that after a stock has gone up 5x in 1 year, it will continue to go up and only up. Well, in many cases, these stocks give many future opportunities to be bought at a cheap price. So it's better to learn how to sit back and watch. Penny stocks are so popular among newbies. After all, they cost only a few pennies. This creates an illusion among inexperienced investors that penny stocks are really cheap. But are they really cheap? So here is a very so-called expensive stock, MRF, trading at 98,000 rupees. Its price to earnings ratio is 53. And here is a penny stock, JP Power, trading at only 6 rupees. But its price to earnings ratio is 72. So you decide which stock is expensive, MRF or JP Power. Please type in the comments section what has been your approach to stock investing as a beginner. Thank you for watching this video, and I'll see you in the next one. Until then, keep your capital safe and have a nice day.